Hi everyone, welcome to my channel. So today we are starting with corporate finance subject of CFA level 2. So in this video we are starting with the chapter 1, that is analysis of dividends and share repurchase. So in this video we would be discussing about the different types of dividends and its effects on shareholder wealth and financial ratios. So, what is a dividend? What is a dividend in simple terms? So, a dividend, it is distribution paid to shareholders. Dividend is distribution paid by the company to its shareholders. So, who declares dividends? So, on behalf of the company, the dividends are declared by the board of directors. So dividends are declared by board of directors of the company, and it now dividends are declared, but the dividend payment may or may not require shareholder approval. May or may not require shareholder approval. Okay. So why did I mention it as may or may not? So in most of Europe, shareholder approval is required, most of Europe, whereas in the case of USA, shareholder approval is not required. Now, what about India? In India, in India, for final dividend payment, for final dividend payment, shareholder approval is required. Final dividend payment in a financial year, for that shareholder approval is required, and the shareholder approval is taken during the AGM meeting. Approval required. So now we have understood that dividends are declared by the board of directors of the company, and it may or may not require shareholder approval. Now let us understand the concept of ex dividend date. What is ex dividend date? So I would draw a line. So ex dividend date, it is the first date the share trades, the share trades without the right to receive, without the right to receive dividends for that period. For that period. So if we take it in the form of a number line, there would be a date when the dividend is declared. So I can write the first one as dividend declaration date by the board of directors. Dividend declaration date. Now, then comes the ex dividend date. Ex dividend date. So, this is the first date from which the shareholder is not having the right to receive dividend payment. So, for any shareholder, So on this date, on Ex Dividend date, the company records the shareholders, like it will look into its ledger and check who all are the shareholders of the company. So on this date, who all are the shareholders of the company, they are eligible to receive the are eligible to receive the dividend payment. But from this date, whoever purchases the shares of that company, they are not eligible to receive the dividend payment. And dividend payment would be on a later date, which would be declared by the company. So in this case, dividend payment date. So whoever buys shares during this time, they don't have the right to receive dividends. So they won't receive dividends. Okay. So, ex dividend date is the record date usually, and it is the date on which company looks into its ledger who all are the shareholders, and only they are eligible to receive the dividend payment. So, on from this date, whoever buys shares of that company, they are not eligible to receive dividend payment for that period. So, during this duration, whoever buys shares, they won't receive dividends. So, in this example, it is ABC Limited, a fictitious company. So, ABC Limited is a company based in India. For the financial year ending May 31, 2026, in India, the financial year is April to March. So, for the financial year ending March 31st, 2026, ending on for the financial year ending on March 31, 2026, the company has declared a final dividend payment of rupees 7. So, company declared rupees 7 final dividend payment for that financial year. So, the announcement for this dividend payment was made on May 21st, 2026. The record date or ex dividend date is given as May 27, 2026. AGM meeting and annual general body meeting would be conducted on July 20th, 2026 for shareholder approval, and the proposed payment date is July 25, 2026. So in this case, if I draw the timeline, the announcement date, that is dividend declaration date, dividend declared on May 21. So this is May 21. Now the second thing is the record date. So the date on which the company is looking at the record into their records who all are the shareholders of the company. So it is the record date or ex dividend date and ex dividend date. So any person who buys the shares from May 27th would not be eligible to receive the dividends, because on May 27th, if you buy only uh, in India, the trades settle on a T plus one basis, equity settle on a T plus one basis. So your name would appear as a shareholder in company's records only on May 28th. Hence, if you buy a share on May 27th, you are not eligible to receive the dividend because your name would appear on the records only on May 28th. So, if I buy the shares on May 27th, I won't receive the dividends, but the person from whom I bought the shares would receive the dividends because that person's name would be on the record as of May 27th due to T+1 settlement cycle. So May 27th is the ex dividend date. Now then there is an AGM meeting for shareholder approval. So this is not mandatory for every country, as we discussed. Like USA doesn't require shareholder approval. Most of Europe requires shareholder approval. In India, for final dividend payments, shareholder approval is required. So AGM meeting is on July 20th, and then if it is approved, the payment would take place on July 25th. So dividend payment date. So from this date to this date, whoever buys share, uh, they are not eligible to receive the dividend payment that is going to take place on July 25. So the shares trade without the right to receive this dividend. So that's how dividends are declared and paid out. Now we understood what is dividend, then we learned what is ex dividend date. Now let us understand what is a payout policy. Payout policy. So, payout policy is the company's policy regarding the payment of cash dividends as well as share repurchases in any given year. So, it guides the company about cash dividend payments and share repurchases. So, payout policy is companies. It is the company's payout policy is a set of principles set of principles guiding cash dividends cash dividend and share repurchase during sorry in any given year. So that is what is payout policy in any given year. Now, another name for payout policy is distribution policy. So, another name for payout policy is distribution policy. So, it is a set of principles which guides the company about its cash dividend payments and share repurchase. Now, payout policy is more broader than dividend policy because payout policy is broader than dividend policy because it uh, it reflects the fact that companies can return its investment to shareholders by two means: share repurchase and cash dividend. So it reflects the fact that companies can return cash to shareholders by means of, what are the two ways to return cash to shareholders? First is share repurchase. So, repurchasing the shares back from the shareholders is a way to pay back the shareholders. So, share repurchase. And the second one is cash dividends. Okay. And the set of principles that guide share repurchase and cash dividends is known as payout policy. Now, it is different from dividend policy. Why is it different from dividend policy? Because dividend policy is a strategy that the company follows to determine the amount and timing of only dividend payment, of only dividend payments. So it is not considering the payment option of share repurchase, payment option by share repurchase. That's why, like, dividend policy only considers uh, dividend policy only considers returning investment to the shareholders in the form of dividend payment, and it is not considering share repurchase. That's why payout policy, which considers both share repurchase and cash dividends, is broader. Okay. Now, dividends and share repurchase concern analysts. So, we as analysts, why would dividends and share repurchase of a company concern us? So, dividends and share repurchase concern analysts. Why? It concerns analysts because, first, they affect the investment return. They affect investment return because the cash that would be with the company is now being paid out to its shareholders. So the company value would decrease by that amount, right? So it would affect investment return. Second, since again cash is being paid out, it will affect financial ratios. And third, dividend declaration usually gives out a signal about the future company prospects. So we would learn about dividend signaling in a later video. So it gives out important information about future company performance and returns. So that's why dividend declaration or share repurchase declaration is important to analysts. Like they it concerns analysts. Now, now let us start to let us start to study about the different types of dividends. So there are, actually, as per curriculum, there are 5 different types of dividends. So which are the 5 different types of dividends? So companies can pay dividends in a number of ways. Okay. So first is regular cash dividend. So we will learn about each of these in a few minutes. I'll just write down the different types of dividends. So first is regular cash dividend, then it is extra dividend or special, like the different names for the same dividend. So extra dividend or special dividend or irregular dividend. Now the third one is liquidating dividend. So these three types of dividends are usually cash dividends. So these three types of dividends are cash dividends. So apart from cash dividend, there are stock dividends. So then we have stock dividends and stock split. So these are the five types of dividends. Now stock split is a type of dividend as per CFA curriculum, but as per some books, it is just a corporate action. But since we are studying for CFA level 2, we will learn it is a dividend. So the five different types of dividends are regular cash dividend, then extra, special, or irregular dividend, then liquidating dividend, then stock dividend, and stock split. Now let us understand what is a regular cash dividend. So we can start with regular cash dividend. What is a regular cash dividend? The name itself suggests, right? It means that uh, the company distributes dividends on a regular schedule. So, company distribute dividend on a regular schedule. Now, the frequency of paying dividends vary depending on the company. It can vary depending on the sector. So, frequency of payment vary depending on markets, sectors, etc. Okay, so now we can just look at uh, an overview about usually how does companies in different countries pay dividends, regular cash dividend. So um, geographic difference geographic difference is in the case of United States and Canada, uh, most companies pay quarterly dividend. Quarterly dividends. Most companies pay quarterly dividends. Now, when we take countries such as Australia, Japan, most of Europe, so in this case, what happens is dividends are paid semi-annually, not quarterly. Most companies pay dividends semi-annually. And when it comes to countries such as when we take countries such as Germany, India, Egypt, and most Asian countries, like I know here I mentioned Australia, Japan, but other Asian countries, they usually pay annual dividend. Annual dividend. So it is not like absolute, like it varies depending on the company sector, etc. It varies depending on the companies. It varies depending on the sector in which the company operates, like is it in technology or is it in FMCG, that is fast moving consumer goods. So annual dividends. Okay. Now for in the case of companies that pay regular cash dividends, one thing that the companies strive to maintain is companies strive to maintain their regular payments and not to go below what they used to pay as regular dividends. So companies strive to maintain or increase their dividends. Now, why is that? Why do they strive to maintain or increase their dividends? It's because earlier I mentioned analysts look out for dividend declarations, right? Because it gives out certain signals to the investors. So, if the company maintains or increase its dividend, it is usually considered a positive signal. So, consistent dividend over a over long term is usually considered as a good evidence of consistent profitability. Consistent dividend over long term is considered as evidence of consistent profitability. Evidence of, because normal shareholders don't have the information as much as, don't have company information as much as the company's management, right? So they look into certain signals for profitability, company performance, and dividend declaration is one of the signal. So consistent dividend over long term is considered an evidence of consistent profitability. Okay. Now we have discussed about it. Now what happens if the companies reduce their payment, dividend payment? If they reduce the dividend payment, it gives out a signal that company is in a bit of financial trouble, or like then there would be increased scrutiny. So that's why when most companies if the companies are facing temporary problems, then also they won't decrease the dividend payments. They'll strive not to decrease the dividend payments. So most companies strive not reduce, they strive to not reduce dividend even when facing temporary problems. Even when facing temporary problems. So, because if it is temporary, they don't want to give out a signal that company is in any kind of distress. So that's why they try to maintain the regular dividend payment, because management uses or management can use dividend announcement as the confidence in company's future. Management can use dividend announcement to signal confidence in company's future. Means future. Okay, so it means that management uses dividend announcement to show its confidence in company's future, if it is maintaining the regular dividend payment or if it is increasing its dividend payment. So an increase in dividends is usually has a positive effect on share price. Positive effect on share price, because it tells the investors that management is having confidence in the company's future. Positive effect on share price. Okay. Now we learned about regular cash dividends. Now we can move forward and study about extra, special, or irregular dividends. Okay. So let us now study about the second type of dividend, which is extra, which is called extra dividend or special dividend or irregular dividend. Okay. Now what is special about it? What is special about this type of dividend? It is usually paid by the companies that don't pay regular dividends. So not all companies pay regular dividends. Okay, one point I had forgot to mention is that dividends are discretionary. So management dividends are paid at the discretion of the company's board of directors. So it is not compulsory. That's why uh, some companies pay regular cash dividends, whereas some companies don't pay regular cash dividends. So for companies that usually don't pay regular cash dividend, if they are having a really good year, a really profitable year, then they may initiate a dividend payment. So not a regular dividend payment, but a one-off case. So it is paid by companies that usually do not, or the company that usually does not pay dividend on regular schedule. So if usually in the case of tech companies, they don't pay dividends on regular schedule because they try to conserve that amount, that cash, for other investments, because they would like high growth industries require high amount of cash investment always. So instead of paying out regular dividend, they conserve it for their other projects, their other capital projects. Now, it can be that case, or it might be to like the companies which pay regular dividend, but that company had a really good year. So to supplement the regular cash dividend, supplement regular cash dividend, this or 1 minute. To supplement regular cash dividend with an extra payment. Okay. So companies which pay regular cash dividend, but they had a really good year and they want to give an extra payment to the shareholders, so they might declare extra dividends. Okay. Uh, Now, what uh, I'll write down the reason why they usually pay extra dividend or special dividend. So usually paid due to special circumstances, tenses. Example: good year, year with high profits. So in this case, the company might decide to share its profits with the shareholders. So in this case, uh, share profits with to share profits with shareholder, a company might announce extra dividends. Now here, the companies that usually don't pay regular dividend, example, most tech companies. Tech companies, because they need investment for in the high growth sector, or for development, R&D, research, etc. Also, companies in cyclical industries have sometimes chosen to pay special dividends instead of regular dividends, because they will only share dividends when they have a profitable, when they have a good year. So another example is another example is companies in companies in cyclical industry. So this is also from the first one, companies in cyclical industry. Sometimes choose to pay, sometimes choose to pay dividends during strong earning years. Otherwise, they conserve the cash for like other investment opportunities, or if they expect a weak turnover, if they expect a less profitable year ahead. So in that case, they will conserve the amount that could be paid as dividends. But during strong earning years, they will pay extra dividends. They will pay special dividends, like extra dividends. That name can get confusing, right? So they will pay special dividends during strong earning years. Okay. Now, during economic downturns or low negative years, the dividends are conserved. That's why extra or special or irregular dividends are paid, because instead of paying regular dividends, they only pay during strong earning years or any special circumstance like a company spin-off. Otherwise, they don't pay regular cash dividends, or companies that pay regular dividends may supplement it with extra dividends to share profits with the shareholders during an incredible year, etc. Okay, now we can just have a recap of a formula, that is cash dividend payout ratio. So to calculate cash dividends, a payout, the formula is cash dividend divided by earning per share, EPS. Earning per share. So the formula for cash dividend payout ratio is cash dividend divided by earning per share. Okay. Now let us understand the third type of dividend. Now based on this equation, we will solve a problem, uh, but in the next video. For now, let us first understand the different types of dividends. So, and the third type of dividend is liquidating dividend. Liquidating dividend. So, what is a liquidating dividend? So, name itself suggests what kind of dividend it might be. Liquidated. Liquidating. It means liquidation. A company's liquidation is taking place, or something like that, right? So, liquidating dividend is a dividend. Uh, so, this dividend is referred to as liquidating dividend because it is paid when a company first liquidation, that is when a company goes of business and net assets of the company after all the liabilities have been paid off, after liabilities are paid, because shareholders usually are last in the line of receiving payment, right? So, in the case of liquidating dividends, it is paid by the company which goes out of business, and when the net assets of the company are getting distributed, so gets distributed to shareholder. So it is not out of any revenue that the company is paying dividend, but in this case, the company is going out of business. So then, from the net assets of the company, it is paying out shareholders. So that's liquidating dividends. It is one of the situation. Other situation is liquidating is a dividend is called liquidating dividend also when the company sells a portion of its business for cash, portion of business for cash, and the proceeds are paid to shareholders. The proceeds are paid to shareholders. Okay, so that's the second situation when a dividend, when we can refer a payment as liquidating dividend. Now, the third situation is if a dividend payment, if a dividend payment is greater than the accumulated retained earning of the company. So if the dividend paid, if the dividend paid is greater than the accumulated retained earning, it means that the company is paying a dividend which the company doesn't have, like from a cash that the company doesn't have. So it impairs stated capital, the capital that is stated by the company. So it impairs stated capital. So that's also when we can say the dividend is liquidating dividend. So the other two types of dividend, that is regular cash dividend and extra special or irregular dividend, it is actually out of the profits of the company, right? But in the case of liquidating dividend, so we saw three situations. First, it was when company goes out of business. Second, when company is selling off a portion of its business. Third, if when it is paying dividends larger than its accumulated retained earning. So that's why liquidating dividend, it is actually a return of capital. It is not from the profits of the company, but it is a return of capital to shareholders rather than distribution from earnings or retained earning, rather than distribution from earnings or retained earnings. Okay, so that's about liquidating dividend. Now we have another type of dividend, that is stock dividend. So we can discuss about stock dividends and stock splits in the next video, because now this video has become a bit lengthy, right? So we will discuss about stock dividends and stock splits and reverse stock splits in the next video. That's all for today's video. Thank you.